GetCrack. Wake up, motherfucker.
All right, what's up, guys? It is Sunday night, February 23rd, 2025. So I was trying to, I don't know, I just kept looking for stocks to talk about and all whatever, going through all the scans, but man, I haven't found anything new. So most of the stuff we've been talking about, most of those stocks we've been talking about, they're still in play. But they got damaged quite badly on Friday. So it's going to be a big risk, right? Big risk. And right now I'm looking at DNA, still looking at that one. So it took a damn big hit right last week, 26%. All right, AOI was actually green. It was trying to be up 10% for like half of the day on Friday before it just collapsed. And that went down like what, 1%, 2% by the end of the day. That's another one. And both of them have earnings coming up, right? So let's see. AOI has Wednesday. DNA has Tuesday. Tough call. Lots of tough calls here. The Chinese stocks, yeah, still doing fine, as I mentioned last stream. And so it's going to be a lot harder, I think. It's going to be a lot harder for to actually say, like, well, you got to chase that stuff up. But Samantha LeDuc, I played the video. She's still quite optimistic about it. So that's interesting. I think that says something. That she's really confident about that. So I'm going to keep looking at those Chinese stocks. Yeah. So let's see what's earnings this week. Hims and hers. I don't know. Martin Scully won't want to go long on that one through that. I don't know. Maybe he already got out. Do a quick scalp. But yeah, HIMS Monday after the close. And then you have Tempest AI, TEM. So not sure if HB wants to go through that one over the earnings. Yeah, you can take how many times you're going to take a chance, Home Depot Tuesday morning is going to be a big deal. That's going to say a lot about how contractors are spending. And then you have Lowe's Wednesday morning, LOW. So that one's more consumer side. They're going to do like gardening and home improvement. They go more towards Lowe's than Home Depot. Home Depot's HD. I might look at Planet Fitness on Tuesday morning too, PLNT, but I don't know. I never really play that one. Digital Ocean, DOCN, Tuesday morning. Okay, software one. And then you have CRM Wednesday afternoon, AI Wednesday afternoon, Snowflake, SNOW, Joby, JOBY, IONQ. So all these risky stocks, including a bunch of software companies, and you have the Bitcoin miner Mara, MARA. Oh yeah, advanced auto parts suck. Actually, no, never. I'm not gonna care about that one. It's O'Reilly and AutoZone. They do the best. I don't know. Advanced auto parts, terrible. Their margins are always collapsing. And we have Nvidia, NVDA. Obviously, that's the only thing people are worried about on Wednesday. That's it. That's the big boy right there. That's everyone's waiting for that one. That will decide how the whole market moves. Then on Thursday we have VST, so Vistra Energy, nuclear infrastructure, and then you have GEO, private prisons that Michael Burry used to be in. I'm not sure if that's going to be still a hot stock, so I'm going to be watching that one. And Opera, OPRA. That browser, I don't know. That stock is interesting. I never really played it, but the chart is always good to look at. So who knows? If software really is going to be a bigger thing this year, I wouldn't buy now though. But we got to see how the earnings reactions are, how they turn out. Yeah, it could be good. And you have Norwegian cruise lines. So cruise lines have been doing quite well for the past 6 months to a year. So this is probably one of the best ones. NCLH. I don't know if that's like something people are interested in buying for a long-term one. And we have Archer Thursday afternoon, ACHR. So that's ones with the electric vertical takeoff and landing taxi. That's the same thing with Joby, Joby on Wednesday. So those two are in the same group. Duolingo, we talked about that one before last year. DUOL, see what the earnings are. And we have Sound, SOUN, another one. That was a hot one last year. Okay, I'm curious to see how they look. And then we have Rocket Lab, RKLB, very popular SpaceX type stock where they do cheaper launches, so they're more economical, kind of like the Dollar Tree of space, I guess. So yeah, that's what I'm paying attention to, but mostly Nvidia. I think Nvidia will be the be all end all, and that's the one we gotta look at. So NVDA Wednesday after the close, that will decide the whole market. Okay, now let's see. Let's see what we got here. Let me read some article for you. One article, very short, and then I'll play videos because I don't think I have much to say. I was hoping I could find more stocks, but as you can see in my scans right now, and actually, if you want to look at how I do my scanning for this one, I'm using the same one I did 1 month ago, and I'm going to give you a link with the timestamp to the last video with where I start talking about the scanning. I think this is the correct timestamp, so you can go to this video. But what I did was I used the same scan here, okay, and you can go to that old video to look at. Very simple. And then this time around, I got 1,822 hits because it was a terrible day on Friday. But before Friday, we had a lot of stocks having good trends, right? And then I'm using the scooter ranking. So this is the stock charts technical ranking to sort out the top ones. And we have the same stocks we've been looking at. Like we got RGTI that does the quantum computing, same thing. But you see, like the thing is, took a fat hit, right? We've been taking a fat hit since what was this, January 13th, and it hasn't really gone anywhere. So same thing, no deal. And you'll see the same names repeat themselves. QUBT, same thing. Quantum computing. We've talked about that already. RKLB, this one took a terrible hit on Friday. Yeah, we already talked about it already, though. So the same usual suspects. Reddit, earnings, terrible. And then Friday didn't help, right? Hood, yeah, I think we mentioned once or twice, but I haven't really paid attention too much of it. But it had a good pullback. Good pullback. Is it good to buy tomorrow? I don't know. I gotta see. I gotta wait and see. See what else. Oh, I don't know about that one. That's probably too trashy. IONQ, we talked about that already. Earnings this week. LUNR, another space stock. So yeah, many stocks here are in the software like Net, Cloudflare. We talked about earnings before about this, or they're like kind of like in the nitty gritty, small cap, mid cap, speculative. So the Archer is the same thing, right? We have earnings, electric, vertical, takeoff and landing taxi business. So yeah, many familiar names. Piton. Oh, yep, I mentioned that 2 weeks ago, and then another time last week. I think I was looking to get into it, but yeah, it had a nice looking chart. But as you can see on Friday, no deal. Right, we got to see AOI. Yeah, I already just mentioned it today. MicroStrategy, same thing with Bitcoin. Don't know. I think Antoine was trying to get into SoFi, right? Doing covered calls. Yeah, let's see. Maybe it can bounce up. So that's another one. LEU, nuclear, same thing. We talked about that one already. LEU, Centrus. Oh, man. So a lot of familiar names getting hit here. A lot of familiar names, but I don't know. These smaller ones, healthcare, it's just pharmaceuticals, e-health. Ugh. Yeah, I don't think I'll trust some of those. Root's a meme stock. Yeah, I remember those ones. Those A-Lab, I think I mentioned before, but never again. WKey, that's a meme stock. Yeah, that was a popular one back in the day. VST, yeah, we talked about that, right? Earnings this week, Thursday. Nuclear. Oh, Lemonade. Lemonade is a software company. LMND, same looking familiar looking charts here. Oh my. Oh, I remember this guy. I used to play this one years ago. Went to 5 and now it's 12. I don't know. Maybe I'll look at it again, but I don't like, never liked that one. Planet Labs. Okay, yeah. Space Dock. FFIV it had earnings last week. Yeah, okay. Software company. Yeah, a lot of familiar names. Lots of familiar names. Netflix? Oh, no. I ain't going to jump in that one. It's too high now. Oh, Geo. Yeah, see? Private prisons. CrowdStrike. CRWD software. No, lots of familiar names. Lots of them. But nothing really stand out, nothing new. I haven't seen anything where I'm just like, oh yeah, let's go into a new one. Because I think all the tickers I've mentioned the past 2 weeks. Oh yeah, this one too, like natural gas. Yeah, we'll have to look at natural gas again eventually, but it's got to cool off. It's got to cool off. Toast is a. Oh man, why do they all have similar looking? Yeah, software again. Similar looking charts, very similar. They all move alike. Yeah, nothing really. Oh yeah, this one. Hmm. Yeah. I put this on the list once before. I haven't talked about it too much. Talon Energy, TLN. It does have a good chart. Better make a note of it. I probably we'll go back to this one. Sound, yeah, we talked about that one. Earnings today. I mean, not today. I mean, this week. Wells Fargo. Yeah, bank stocks have been doing quite well. Bank stocks. Adam. Yeah, I remember this one. I played this one years ago too. So it went from 2.5 to like 15 and crashed right back to 5. Ugh. Hmm. Wow. This one's wild. I don't know. I don't like that one. Royal Caribbean. Oh yeah, earnings this week. Oh, this one's good. Maybe RCL is good. Maybe this cruise liner might be good. Okay. All right. Yeah, I don't know. I tried to find something really new for you guys, but I didn't really see anything. Like a lot of them are just penny stocks or stocks that just really. Oh, RSI. Oh, strip clubs. Isn't this strip clubs? Yeah. Okay. Went to 16, pulled back to 14. Okay. Okay. I'll keep this one in mind. Strip clubs. All right. Another bank, Citigroup. Yeah. And then we have, yeah, CES. Banks have done quite well this quarter. They had very good earnings. Yeah. Baker Hughes. Yeah. That's got oil, refinery types, infrastructure types. Yeah. Okay. Funko Pop. FN. Oh, this one. Still stuck at 14. Forget it. Let's see. Yeah, natural gas. I'm waiting for this one. Okay, to pull back some more. CEG, nuclear. Yeah, nuclear took a big hit on Friday. CEG. Yeah, already talked about those. Yeah. So yeah, a lot of them I've already visited. Ooh, this is okay. ERJ is a good one. Actually, this is Brazilian aerospace company. I think they just do aero. I don't think they do space, but it's done very well. This one's done very well. Okay, so ERJ, really good. Embraer. I don't know how to pronounce it, but yeah, it's very good. Very good stock. Not sure if I'm gonna upgrade it, but it has a very good trend. This thing I've looked at for years, and it's done very nicely. Very nicely. Yeah, it's really has a really strong, nice trend. It looks like it's gonna continue. Hmm. ERJ. So for long term stock, yeah, but it depends. I think it depends on if they can keep. Oh, IoT. Yeah, Tropes or somebody mentioned this one, so I've kept it on the list, and it did its pullback. It popped again, right? Okay, not bad. Now it's pulling back again. All right, let's see. IoT, Samsara. Okay, something I gotta look at too. Boyd Gaming Corp. What's this one? Man, I don't know which gambling. Some gambling stocks are pretty good. I don't know if they do sports betting. This one. It's not bad chart, but probably could do better. DraftKings didn't do well. I mean, because earnings went well, but then it lost everything from earnings on Friday, so it went all the way back down. So not sure. Yeah, Tesla we talked about. Got to watch that one. See if it's going to go back up or it's going to fail right there. Avago will have earnings. Zoom, oh yeah, we have earnings this week. Cipher Mining, yeah, we have earnings this week. CIFR, Zoom is ZM. Proto Labs. Did I talk about this one? I think I did, but I'm not sure if I did actually. I know of it though, but I might have not mentioned it in stream. Okay, now we're getting down to the 80 percentile here. Let's see. Nothing. Anything really good? Yeah, I don't like charts that do like that. I think AT&T was also did pretty good from earnings too. AT&T. Zillow's okay. Stock ticker Z. Oh, this one. Corning. Corning's interesting. It's a glass making company. They do they were the first ones to do the glass for the iPhone, the first iPhone. So without Corning, you wouldn't have an iPhone. Actually, so they developed a special glass so you can do the touch screen and all that. And they also were in charge of the UFO looking headquarters in Cupertino. So the new Apple headquarters, they did the curved glass. So GLW, I mean, yeah, that's a good, yeah, but I wouldn't buy it now. It's at 50 something. Yeah, I wouldn't buy it now. Let's see. Yeah, eh, I don't know. Yeah, there's some good stocks, but not really anything I would really heavily consider buying before March. Okay, so I covered a little bit of that, but I'll have to go through this list more carefully and see if I see anything really something I would trade right now, because I'm just looking for trades. I'm not looking for something to buy and hold at this point, because if you see here, like the cycle chart here, you can tell. So we've had our dip, right? Into January 13th. We popped, and now we're in another high peak here. So somewhere in the next couple weeks, I'm expecting trouble. If we pass Nvidia, then there will probably be a very extreme pump. People will be so happy. They'll go up. And then you have GDP on Thursday. All right. You'll have some estimate on the next quarter's GDP. And then you have your PCE number on Friday. But PCE should not be a surprise, typically. But last time we did have a surprise, but it was bullish. So the January one popped. So it really went up. I don't know if it'll do it the same this time, because if Nvidia does good, GDP does fine, and then you got the PCE, you have enough strength to go all the way through Friday next week, because Friday next week is when we get our next monthly payroll numbers. That's the big economic number at that time. All right. And then let's see. Oh, okay. So, oh yeah, I'll read the article first before I get into this one. But we'll get into April. That's probably where the bottom will be. Let's see if that's true. Sometime around tax season, right? And then we'll start rolling back up. So the end of tax season. All right. So that's what I'm looking for. And I'll read this article right here. Oh, actually, before I continue, so I shorted, right, natural gas. You saw me last stream. I showed you I made like $1,000 on one day trade, and then I kept the rest for over the weekend. Just took the risk and said, all right, let's see what happens. So we're up. We're gonna be up in the morning. Hopefully this holds, unless a new weather report comes in and shoots it back up. That's really the annoying thing about natural gas is you'll have weather reports all throughout the day. Every day. Doesn't matter Saturday, Sunday too. So when you hold it over the weekend, it'll just have to absorb all the updated weather reports from both the US and the European like supercomputers. So they have all these weather models that they update, and it shows you how cold things will be 2 to 4 weeks out. And so the last weather models on last Tuesday and Wednesday showed we were going to have a really cold March. All right. So you're going to have like a really cold March, some Arctic blast coming through. So if you're in the, Northeast or Midwest, yeah, you're going to feel some pain if it's true. Of course, they can revise it again, and then you get an updated forecast, and then what happens? Yeah, it rolls back down. So that's why natural gas is really painful for most people to trade. If you're a really good trader, though, you can trade between those updated weather models because they get released across 24-hour period. They know when it gets released, and then they'll just trade accordingly. So that's really what people do. They'll try to scalp it. But I'm just more interested in the long-term effects because I think natural gas will go up from around probably late March, April, right into the summer, June, July. Hopefully, this will be a good push up, and if it coincides with China, so the China economy booming, and then you have more coal consumption from China, that will raise everything else, and then oil should go up. So then the whole energy complex has to move up together because right now it's just natural gas moving up. Oil is still down, still stuck down. Coal is still going sideways, hasn't really boomed anywhere. So once everything goes up, natural gas becomes very competitive. Then natural gas prices has to rise with it because natural gas is a cheap source of energy, and especially with Trump trying to increase exports to Europe and elsewhere. Yeah, that's going to be very good for U.S. Natural gas if we can get that. So overall, it's bullish, but right now, short term, bearish because we've already hit the seasonal limit. Anyway, that's for natural gas. So if you're shorting, you use KOLD, that ETF. So I'm just going to read this article here. The top is confirmed, and now it's just a matter of how low we go. So Tom Bowley is usually a big tech guy, big tech bull. So most of his portfolios, and you can look up his portfolios on earnings beats. Let me see earnings beats. Okay, let me go to the website. Let me see. Yeah. So his portfolios tend to be pretty good. I mean, let's see, since inception, right here. So up 63% with the mono portfolio and 75% with the S&P 500. So when you look at this, you're thinking like, oh man, come on. You're doing worse than the S&P 500. That's why I always tell people, dude, if you do portfolio constructions, it is way hard to beat the benchmark over time. However, if you just look at how he did all the way since 2018 and 2019, all the way through that point, right? So this is one with using ETFs. So this is the bottom one. That's why it's really hard. So for me, that's why if I did an ETF thing where I'm forced to only trade the ETF, like rotate around, that constricts my options. So the only reason I'm beating like the S&P 500 is because I take big bets on certain stocks, okay? And that creates higher risk. So for someone to tell anyone like, hey, so I told this guy his brother had a ton of money, and I said, buy Broadcom because he's older and whatever. I didn't want him to go into Nvidia or whatever. Obviously, duh, you buy Nvidia, it's gonna outperform. But that's 2020 hindsight. So for me at that time during the COVID era, when we were at the top, he was looking for a new stock, and I said like just buy AVGO, Broadcom. Broadcom has done quite well. Not as well as Nvidia, but to me, it was less risky than Nvidia, right? So if Nvidia took a shit, right, it took a big dump in one quarter, I would be like, look, dude, I didn't know it was going to happen, right? You don't know. So I was just gonna give him a stock that had less risk, but it wouldn't go up as much, probably as Nvidia. So you got as much as Nvidia as you can because of right now. Broadcom is, along with Marvell, are like the two semiconductor stocks that can match Nvidia's in performance because of AI. But I chose like Broadcom because it was just like more safe. It was less risky. So that's why this, you look at this ETF portfolio, you see that. That's why it can't outperform the S&P 500. They're restricted to the ETFs. Now, if you just do it with stocks, right? I could pick whatever stock I want. You see here. So he's done quite well. So his model portfolio has done 292% versus the S&P, which has done 123% from November 2018. Now, he has a more aggressive one, but you see the aggressive one, it didn't do as well, right? See, so it the least aggressive one from 2018, you got that, and I guess that was because, like, yeah, 2018 November was the actual bottom, so it's hard to like actually judge, you know. But overall, yeah, yeah. Okay, okay. But what I'm trying to judge here is because Tom is really a big proponent of big tech. So he always loves big tech, but he's always the guy that kind of goes, well, you know, there's a bull market. There's always going to be a bull market, but I'm always going to be, when I see the signs, I'm going to be a lot more bearish. So, you know, he started going bearish about a couple weeks ago. So that caught my eye. I'm like, yeah, this confirms my thinking. March and April might be really bad. Like it's not going to be a small little dip, you know? It's going to be huge. Maybe 15-20% drop on the S&P 500. It's possible. It's possible, right? If he goes that bear, if he's like that pessimistic now, yeah, I'm gonna be thinking like, yeah, it's gonna be something. It's gonna be something big. How's IBM look? Yeah, IBM's good. IBM's good. All seeing guy, but I wouldn't get in now. Like wait for after, because it did have good earnings. Let me check this out. Let's see. I believe it had a very good earnings reaction, and it's kind of like with the GE and all the other type of stocks that used to be bad. Like they went nowhere. Nobody, like everyone hated them. Yeah, it had earnings and it popped up. Yeah, what does it do? 12 something. But yeah. So I it's good to get like Deere, same thing, Deere, and the Chinese car maker BYD, very good charts. So all those are very good, but I wouldn't buy them now. That's definitely not. I think you'll get a good deal come April. So, oh, you already have some. No, there's no more room to run, man. It's over. It's like Palantir and all that. So I said February is time to dump stuff. February is time to dump stuff. Yeah, we're done. We're done with this move. If like right now, IBM at least like doesn't care because it's it's a blue chip that doesn't care. So that's good. Not like Palantir, but it will get hit. So right now, Palantir is what, down 15% from that high last week. Yeah, made a high and then dropped right back down. So yeah, IBM will get hit sometime around next month, I'm sure. Axon will have earnings too. It already got hit already though, down 24%. So yeah, Carvana, same thing. So I'm like, you're not gonna be safe. Like just staying Dow Jones 30 stocks. I mean, is IBM even still in the Dow Jones? Probably not. Let's see what GE is doing. GE got hit. Yeah, 4%. Yeah, that's bad. Yeah, I mean, I would just rather buy more GE too. GE, GEV. So all the spin-offs of GE. It's GE Healthcare, GEHC. Oh, that one's not ready yet. Oh shoot. Oh man, it's back at the top. Yeah. Have to wait for March. Yeah, I'll show this then. let me show this. Because yeah, IBM's part of that group for me. So I like these things like GE because I got into so GEHC is GE Healthcare spinoff. GE Veranova is the nuclear spinoff. It got hit. It got hit. For some reason on Friday they hated all the nuclear stocks, right? So I don't care what the reason was, but I'm looking at it. I'm going like, maybe it's time to jump back in. So and GE Aerospace, yeah, good earnings, whatever, popping, but no, it's pulling back now. So GE, another one. So IBM, same thing. They're all in the same space, like all the same stuff. So all these old blue chip stocks, yeah, very good to get. But as you know, Warren Buffett did his update for investors for Berkshire Hathaway, and he was saying like, yeah, I'm just increasing my cash. I'm buying more T-bills. I am not increasing my stocks positions as much. So he's still raising cash. So Warren Buffett's still raising cash. And I agree. I think this year is just going sideways. There's not much to do. Whatever you made in the past 2 years, that was it. So as you can see in IBM, right? 2020 went sideways into 2023. And then you started going up because this range between 190 and 117 was built in the system quite long ago. So let me go look at a monthly chart. You can see that this one was set in 2012, and then the bottom range was set in the dot-com boom era. So this was it. IBM did nothing. Up and down, up and down, up and down. So nothing, right? And we finally broke it. Finally broke it in August last year. That's what I was waiting for. That's it. That's the final move here, and then we're gonna have to wait because I think March is gonna be trouble, and that's it for a lot of stocks. So, and look at Deere too. I like this chart. This thing has its range. It broke out, pulled back, tested earnings. Great move. Perfect. Do I want to add here? No. 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 I'm gonna wait for March and April. I'll decide then. This ain't the time. So, and there's plenty. Like we got like Boeing, we can watch, we can look at Intel. So these are the next ones to move up, right? Intel got a pop. So it had a whole move last month, 28, like this month, basically. Well, this month's not even over. We got 1 week left, 28%, right? Right back to this range, set to $25. So is it going to break out now and go to 32 before pulling back down? I don't know. If Nvidia does well and the semiconductors move up, yeah, I could see this thing explode to 32 temporarily into like the first 2 weeks of March and then pull back down. And if the market goes bad enough, yeah, it might actually go back to like $20 again. That's how the market does, man. That's how the market is. Yeah, it's never a straight line up. It's never a straight line down. It's just zigzag, 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 and it does its thing. See? Like here, yeah. Oh boy. Yeah, we got a lot of work the next few months. This is gonna be really annoying. I'm sure of it. Would you short the whole index? Yes. Yes. That's why all seeing guy, that's why I recommended. So for people that don't have margin accounts and or don't know options, then what I use is essentially let me see. Let me find it again. So the last stream I talked about 4 ETFs I would use to short it because this is what I usually do. I would just short, or I mean, I guess this is a poor man's version of hedging. I guess like you could keep your long positions in IBM and then just short the index to make your money back while or IBM is getting destroyed or something like that. If you're not even sure about the timing, I don't know. It's not perfect though. That's why options are better because options you kind of can constrain. Like if you know what you're doing. I mean, if you don't know what you're doing, then yeah, you're probably gonna make it worse. But if you know what you're doing, then it's fine. So here, this is the one I use. Let's see. Oh man, I gotta add spaces to it. Hold on, hold on, hold on, hold on, hold on. Okay. So 3x leverage, bear, small cap ETF, TZA. Okay. So this is what I would use. If I want to short small caps, I use TZA. So it had a good week last week, I guess. A little bit, 12%, not too bad. So yeah, small caps are getting punished. So that's my top one if I wanted to be a bear. Next one, semiconductors, because if Nvidia goes up, then this thing will move down and will get cheaper, and I would get a good place to short it. So maybe we can get it at $15. So SOXS, I've used this before. Okay, SOXS, I used this before, and you know, I actually shorted the week of that whole time when they had that deep seek thing, but I was happy with just 6% and I was out. But had I known, for some reason, people would just start panicking over the weekend and read all those news articles and decide to dump it on Monday, I would have got another like 15, 16%. Fuck. Oh well. I picked the right time to short it. I shorted right at the bottom here at $16 and then it jumped up to 22. So I used SOXS. Yeah, I could have got made more money. Oh well. Oh well. Poor me. I'm always just risk averse and I don't like weekends. I don't know where it's gonna go on a weekend. WebS, another one. Not bad. This one's doing quite well. So internet stocks have already been going down, down, down last week. So this was going up, up, up. So we went from $26 to 31. So this was like 20%, right? So not bad. So there are definitely some sectors that are going to get hit worse than others. You have small caps, you got the internet sector, and then of course everyone's favorite, the Nasdaq 100. This thing finally jumped up nearly about what 6%. So 3x of the move of the Nasdaq. So yeah, this is just Friday was just a little warning shot. That's not really where it is. And then the deep seek was just a warning shot. That was just 8%. No, 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 no. I'm waiting for the big mama. So if I'm going to short it, I want to see 50%. So, that's what it is for one of these guys. Nasdaq, you're probably not going to get 50%, but who knows? If it actually went down like 20, well, it's not going to go 20%. I'll say maximum 15% from the top. Let's say so the Nasdaq from the top will be about 15%, right? And then you have yeah. I mean, yeah, that's close to 50. Yeah. 15 times 3 is 45. Okay, so I'm right. So 50%. So 50%. You could get a 50% if you time exactly from the top of the Nasdaq using the SQQQ. And then if it drops 15%, that's 50%. 50. Okay? So 15 to 50. All right? So that's technically possible if you timed it exactly from top to bottom. And using the SQQQ, so if you're lazy, you don't know about margins, you can't short specific, because it's easier just to short like crap stocks. So if you think the index is going down, guess what? Like quantum computing stocks, like so you've Martin Shkreli, you're like, yeah, I'm gonna short this guy, I'm gonna short HIMS. So all the stocks that I recommended when we were going up, go the other direction. These guys are gonna get killed. These are gonna get murdered if they're cheap. I don't know what the interest rate is if you short it on margin, but yeah, you can find individual stocks and hunt them down. SMCI, right? You can just short right now. So I told you right at the bottom when to go long, and now that it's up here, yeah, short SMCI. If you got margin account, go for it. Short that sucker. So yeah, that's it. So all the stocks I recommended, go the other direction. All the other. Oh, Mobileye, yeah, MBL. Oh, man, this thing looked like it was gonna go somewhere, right? Last week, but of course, it gets hit with the rest of the market. Now I don't even know if Mobileye, MBLY, It's going to try again because we don't have many weeks left. Come on. I don't know when if you're lucky, the whole March will be good for bulls. And this thing can go all the way up, all the way up, all the way up to 30. But if it doesn't go up fast enough, we're running out of time. Tick tock, because Powell will talk on the 19th. The Bank of Japan talks on the 10th. In between is the Ides of March. I don't like the Ides of March. And that's about it. So, yeah, we don't have much time here. Okay, all right. That's enough of that. So let me go on to talk about the article I was supposed to talk about, and we'll move on from there. Continuing on, the top is confirmed, and now it's just a matter of how low we go. It was written today, 11 a.m. Tom Bowley. I don't know what time zone that is. Let me start by reminding everyone that I believe the most important relationship in the stock market is how consumer discretionary stocks, XLY, so that's the ETF, XLY, perform relative to consumer staple stocks, XLP. The ratio has a very strong positive correlation with the S&P 500. In other words, when the S&P 500 advances, a corresponding rise in the XLY XLP ratio is to be expected. When it doesn't rise to corroborate the benchmark's rally, it typically leads to lack of S&P 500 follow through. So XLY is essentially like discretionary stocks like Tesla. So if you got a lot of money, I'm going to buy overpriced electric vehicles. If I don't have a lot of money, then I'm going to the dollar store and buying a pack of chips. That's basically what it is. So if people are buying more stocks like Colgate, and Unilever, something like that, shampoo, toothpaste, necessities, then that means they think like, oh, the economy is going to turn or something like that. They're not going to do discretionary. So Teslas, right? So that Tesla is actually a big component of XLY at this point. It's pretty much taken over all of the XLY. So yeah, so that's the only one I remember now. And we have to look at like how Home Depot is going to do and Lowe's too. So in any case, when it doesn't rise to corroborate the benchmark's rally, it typically leads to lack of S&P 500 follow through. I'll show you visually what this positive correlation looks like since the turn of the century. So yeah, we've had some good correlations. And then we have some times where it's inverse correlated. That's not good. So this is the ratio right here versus, and then you can look at the S&P 500 on top. And so when they don't match, when they don't go together, like here, right? This one was just before the big drop bear market correction of 2022. So the peak right here was probably during the time when Jerome Powell was like, uh-oh, inflation is going to be a big problem. And then just after that, this was like around Thanksgiving. So Black Friday. And then after that, Omicron. Yeah, Omicron. So first, Jerome Powell said, whoop, inflation is not temporary. Omicron variant is coming out. And then by that time, that whole thing, the whole ratio was going down. And then when we turned into the New Year's, that's when the big selling started happening and everyone was getting out. Now it's going like, is this another 2021 event? That's a big deal. From this chart alone, it's clear that what happens to consumer stocks and their relationship to one another really matters in the grand scheme of things. Now, let's look at the intraday chart of the XLY and XLP from last week. So this is the Friday, right? This was the Friday move. So this was huge. You had a big drawdown in discretionary. You had a big move up in staples. The top panel is XLY and the bottom panel is XLP. Does anything seem odd to you? Well, for me, the action on Friday and the disparity between the performance of both consumer stock groups really stands out. And when I did some research, I found that this type of disparity where the XLY outperforms the XLP by such a large margin has occurred only 10 times since the financial crisis related bear market that ended in March 2009. 8 of those times happened during bear markets, and one happened during a correction. Friday was the 10th. This type of massive rotation from offense to defense should not be overlooked. In early January 2025, I hosted our Market Vision 2025 event. At that time, I indicated that we were set up for a challenging Q1 and a potential market correction. And on Friday, we got confirmation. I expect we're going to see much more selling in the coming weeks. So that's it. Be aware. Be aware of next coming weeks. And if you go look back at my video from last time, I played all the Samantha LeDuc stuff. And so I think what's going to happen is they're going to trick the early bears. So there's going to be a lot of bears that came in on Friday. They all went short now. Monday is probably going to continue like having weakness. Then as we get closer to Nvidia might be like, oh, Nvidia's not as good as expected, but it's not bad either. So that might actually lift the markets, because the thing is, even though you have bad news, if everyone is already expecting bad news, guess what? The market just goes up because everyone's on the wrong side of the ship already. If people don't expect the bad news and the bad news comes, that's when the market goes down. So expectations is the most important thing. It's always an expectations game. If people expect something bad and the bad news comes and they were already on that side, the market will go up. The other way is true too. If everyone expected the good news came. Oh, everybody was already bought expecting that good news. No new buyer comes in. Guess what? The stock sells off. It's always amazing. Yeah, it's always a psychological thing. So people's expectations and when they buy is more important than what's actually happening. All right? Because if the news was already expected, then who cares about the news? You already expected it. So again, I'm watching this thing. I'm watching this thing going into the end of tax season because it's coming up. Like 1-2 weeks goes by fast. So we'll see. All right, let's see. Yeah, natural gas still going down. So good for me. Good for me. All right. Okay, now let's play a video here. All right. So let's play some Joe Rabel. I like this video that he posted in Stock Charts this week. I think this really highlights his thinking from before, when he didn't do like multi-time frame analysis, and then how he came up with multi-time frame analysis. So this gives a little background to you guys. Okay. So I think this is good. This is good for you guys to watch. All right, and I got my 1080p. All right, I got my 1080p. Let's go. All right. Let me find my videos. And then after that, I'll play a Ray Dalio analysis. That'll be nice. So that's a good. It's gonna be a longer video, but I'll just play it anyway. But this one should be about 30 odd minutes. This one.
Hi, this is Joe Rabel with Rabel Stock Research. So what I want to do today, so many of you know and recognize me as the guy who uses indicators in multiple time frames. I look at monthly, weekly, daily charts, sometimes looking at hourly, depending on the time frames I'm trading. But I like to use multiple time frame analysis in what I do. All right. Now, but when I started in the business, and I started in the late 80s. I really got into technical analysis probably starting around 1989, 1990. And through almost all of the 90s, I used one single chart with a 20 simple moving average, a 50 simple moving average, and a 200 day moving average. So all on the daily chart, I had a 20, 50, and 200. I used MACD and I used volume. And that was it. That's all I looked at. Now I usually looked at a longer term chart of about 2 years because I was talking to institutions, but I did that for a long period of time. I want to explain why I switched over to multiple time frame analysis and what kind of advantage it offers when you look at it in the way that I have it set up. All right, so let's go ahead and get into that. Right, so I have the chart of the Dow Jones Industrial Average up, and I've got a 20 simple moving average up. I've got a 50 simple moving average and a 200 day. Now, for almost the first 10 years of my career, starting in the late 80s, really it was around 1990 when I really got into charting and technical analysis. I was doing point and figure charts by hand, and then I had this chart. This was about a 2-year daily chart with a 20, 50, and 200 day with volume and a MACD. All right, and this is pretty much it. This is what I used for a long time to help, and I analyzed charts for institutions for several years using this approach. It's fine, you know. The 20 represents sort of the shorter term trend, the 50 would represent the intermediate term trend, and the 200 day would be the longer term trend. And we obviously, when we're looking and talking to institutions, we're looking for periods where we're at a pretty important inflection point where the moving averages like the 50 and the 200, or the 50 and the 20 are coming back down towards the 200 and then emerging again, and we have the potential for another big trend. All right. Now, we would use the MACD as supplemental tool. I have kind of in recent years, over the last 20 years, really since 2000, have kind of taken it to another level in the way that I use it. But we would look for periods where we had corrections back down to the zero line, and it was sort of turning at that point or crossing over to the upside after an extended period below. And, you know, look for signs that maybe momentum is slowing in either direction by, you know, looking at the peaks and the valleys. So that was essentially the way I was using this. All right. And the reason why I decided to switch was because we could see the bigger picture moves. All right. Now, there were times where you get periods where you think you're emerging above the 200, but then it would take a long time to actually get going. All right. And what I found was that looking at that monthly 18 was a big plus for this. If we use that in conjunction with the 200 day or this approach, then your timing's going to improve a lot. But the bigger reason why I switched to multiple time frames was these drops like this. So once we get a trend going and you break the 50, or you're below the 20 and then you break the 50, trying to get back in these pullbacks, I thought was incredibly difficult. You almost had to guess a little bit and, you know, maybe use volume a little bit more, look for volume spikes and all that. And it was fine. And again, you know, I was a very, very good analyst in the 90s. I could see what was taking place. You know, you use a lot of different things like group action. We would look at money flow back then. You know, the MACD would help. We'd look at relative strength. So all of those are factors. All right. But what I found when I switched, so now I'm going to switch over to my setup with a Dow Jones Industrial Average with 4 time frames. So I've got a monthly here, I've got a weekly, and then a daily, and then an hourly chart. All right. Now, what I find really interesting, there's a couple things that really struck me when I started using this this multiple time frame setup. All right. Number one, that I could start to see 4 different trends. There were 4 different trends that were taking place at the same time. All right. Now, most of my clients at that point were focused in on the long-term trend. All right. And one of my clients who I had been working with for a long period of time, he was a small cap growth manager who liked to buy on weakness. All right. He would bring up a lot of stocks that looked like they were breaking down. So I'm going to give you what this looked like on this chart. So it looked like what the Dow Jones looked like here in late 2023. It looks like it's breaking the 200-day. It looks like it's reversing to the downside, right? I mean, and this looks like a complete failure in the pattern. And he would bring up stocks like this. And he loved talking to me because I would say, hey, there's a significant amount of support underneath. This is where the support level is. And he knows fundamentals. And he's saying, look, I'm buying on weakness and I know this is a good opportunity. So I'm going to buy when it's down here. And I'm sitting here thinking, this guy is an idiot. I mean, he's buying breakdowns, even though there was support. But the more we spoke, and the more I would see he's on the cover of Barron's, I see he's one of the top performing small cap managers. I got to give this guy a little bit more credit than I was giving him because I kept on thinking every chart he's bringing up to me looks like crap when I'm looking at it with the 200-day and the 50, and the 50 gets a bear cross, whatever, the 50 crossing down below the 200. This was happening a lot. All right. And so when you switch over and you start to look at multiple time frames, now all of a sudden I'm looking at a 10-year monthly chart and I've got an 18-month moving average. All right. Now that dip, that pullback, what looks like a breakdown pulling back into support is actually a pullback into the rising, or what's now rising. It was falling, but now it's turning at the 18 and the 40-month moving average. All of a sudden, from a long-term standpoint, this chart looks really attractive. And then I could actually add a lot of value to this client. And I started to implement this across the board and realized that by using the 18-month moving average, we can eliminate a lot of the false signals that are used using a 200-day moving average. Now, sometimes you get a lot of momentum to the downside on the break of the 200, and that's maybe going to be the precursor to a break of the 18-month potentially, but that is factored in because we've got 4 different time frames, and we have 4 different trends, but we also have 4 different signs of momentum. Remember, back when I was just using a daily chart with the 20, 50, and 200, I only had this. This was the only momentum indicator I was using. Now, I added in the ADX around 2005, but even using it with what I had, if I had MACD in 4 different time frames, it adds a massive amount of value. Do you see how this is holding above the 0 line and turning back to the upside? As this is turning here. So I'm just pointing out one specific event, but I can tell you for a fact that this happened over and over again, and I started adding a significant amount of more value. Now, the other reason why I think this is so valuable is the fact that I can take advantage of pullbacks so much better now. Looking at these pullbacks on a daily chart as it looks like it's sort of breaking down. I can take advantage of those breakouts on this time frame using my opposing trend strategy, which is essentially taking advantage of corrective patterns, ABC corrections, and looking for entries on the smaller time frame using the help of MACD and ADX. All right, now I'm using this time frame momentum to determine how strong the trend is, and then I'm using this time frame to determine how strong the pullback is, and I can add a significant amount of value to the timing of the event and I get a lot more opportunities using this type of setup. So I thought it was worthwhile just spending a few minutes going through this. Let's go ahead and move on now. If you're enjoying the content, hit that like button and also subscribe. So my services can be found at rabelstockresearch.com. I'm on the services page right now. You can see at the top, I've got the advanced trend and momentum courses individually priced for lifetime access. Plus you could buy them as a bundle at a discount. And then also the individual package has about 2 to 3 reports each week, plus a special video commentary each week for that package. Also, if you're new to this approach and you want to just learn more about it, you can start with the book I'm offering at a discount right now. My comments are for educational purposes only. Please do your own due diligence before making any investments. All right, I'm going to start out with a couple of indices. I want to look at a commodity chart. I want to look at my favorite crypto pattern right now. And then we're going to talk about one of the Mag 7 stocks that I think could be in trouble here. We'll have to see but at least something to keep an eye on. And then we'll go through the symbol request. So let's start out with the QQQ. And what I want to zero in on is what's taking place here as this is attempting to break out. All right. Now, I mean, if you look at this, we did in the S&P, we did eke out a new closing high. I believe this did as well. So we're looking at this pattern that looks like it's trying to emerge after a nice consolidation. Okay. However, I mean, this is not the bar. So let me just zero in on this is not the kind of bar that I would be looking for a breakout bar. All right. That is not the pattern that we should be on the lookout for. If we got a bar that looks something like this at a breakout, even this one doesn't really appeal to me, because you can see we've got pretty good sized bar here and then a strong bar here as it emerges out of this. But then the momentum starts to shrink. You can see that with this tiny little bar. So we want an expansion bar, or at least a normal sized bar, right? I mean, at least something that would be somewhere in the middle of average. Ideally, we'd want a monster green bar. If we got a big breakout bar, then that would show signs of real buying pressure. However, in this instance, because we had green bar, green bar, green bar prior to the breakout, this might not be such a bad thing that it's failing here. If we can come down and kind of hold this support area, form a little handle here, all right, then we can break out and not be overbought. Because what I teach is I like to buy on bar number 1 or bar number 2 on a breakout. Bar number 3, bar number 4, bar number 5, I'm not a huge fan of buying upside breakouts after we're up 3 or 4 days in a row. So if we can pause here and then emerge again and again get a decent sized bar that's green on a breakout and clear this area, then I think we have something that could create some legs. So I would be on the lookout for that for both the QQQ, the NASDAQ, as well as the S&P. All right, let's take a look at the IWM. I just think this is kind of faltering on a relative basis. One of the things I've been talking about over the last month is this big green bar to attempt to break out and then immediate eraser bar, right? King bar, queen bar, bull, or what I would call bear 180, where we just reverse. We go up and then we give it all back. So now we've got this resistance. We've tested it a couple of weeks now. We need to get through it. We need to get through this 230 level. And if we can do that, then I think it might be, more interesting. But I'd like to see green DI kind of kick into gear again. I'd like to see the MACD cross over the signal line, both on the weekly chart. And, especially I would like to see this relative line start to show signs of improvement. Really has been dropping off since late last year and hasn't really recovered from that. So something we got to keep an eye on. Now, an attractive pattern that is developing here is in the commodity index tracking fund. All right. Now, this is heavily weighted towards energy. We've got natural gas actually really kicking into gear here, but look at what's going on this monthly chart. We've gone through this sort of corrective pattern, and MACD, which was really overbought a few years ago, has now worked its way back down towards the zero line, and we don't have a lot of selling stream. But what I wanted to point out is that we look at the quarterly chart. The quarterly chart is actually showing that we were way overbought, had sort of an extreme there at 30, which was a resistance area. And now we've worked it back to the 18 MA on the quarterly chart here. Look at the volume pattern. So I think this is pretty attractive. If I switch this back to the monthly, we can see that this is actually the lower time frame, where the quarterly is the upper time frame. And if we can get a lift off of this, break this downtrend line, show some signs of strength, and kind of emerge out of a low ADX condition, I think this could be the start of something. So I would suggest really keeping an eye on that. Now let's take a look at this one. This is LTC, and it really is, to me, the best looking crypto pattern, all right, at this point. Now, I don't dislike what's going on in Bitcoin, but you can see what's taking place. When we look at this from a bigger picture standpoint, we've been we were knocking our head up against and trying to get through the 100 mark. Now it looks like we're using the 100 mark as support, and the volume pattern is improving. All right, you can see that on the monthly chart. Look at what's going on the weekly. Now, there is a lot of volatility in these crypto patterns. All right, you're just going to have to live with that. But the way this is playing out, it looks to me like pretty strong buying underneath. And there's a pretty good chance that this is a continuation signal that we could see a breakout and follow through in this one as well. So certainly something to keep an eye on. All right, I wanted to take a hard look at.
All right, so big things he mentioned was the commodities space, right? So oil, natural gas, I think is going to be a big player from halfway summertime this year. So probably halfway this year into next year. And this will be the end of the bull market. So when you see commodities really flying, you see the gold, you see the silver. I don't know if silver and gold will really fly that much anymore, but let's see if it can. And then we see palladium, platinum. Then you see oil, natural gas, all that corn, right? I talk about the grains, corn, soybeans, wheat, all push up. Once you see all that stuff push up, that's it. That's the end. So we're going to have one final move up on everything there in the commodities. And then you'll see aluminum and copper and all those things probably catch up, go back up again. I'll have to see which aluminum, copper, and then you'll see fertilizers, things like that. All the stuff will start moving up depending on the tariffs and all that, and Ukraine and Russia. But once we get all done with this final move, that'll be the end. So I don't know how far we're going to go into 2026. Okay, that's what I'm watching for. 2026 will be the final blow off. Then you'll look at real estate, see where the real estate peaks out late 2026, early 2026, something like that. And I've told people, like, if you were thinking of selling your house, probably late 2025, early 2026, to give you some buffer before the final peak. And then you already sold your house by then, signed the contract, then you're out. And so if you're looking to sell, especially in an urban environment, like you need the cash, like for some reason, and you're already gonna plan on selling, then yeah, it's probably the good price you'll get for several years, probably maybe even like 5 years or maybe even a decade. I have no clue how bad things will go, and this next video will show you how bad things could be if we don't kill the debt. So this one's from the Foundation of Study Cycles. I'll play the rest of this one. This is the last video we'll play tonight. This will be like about an hour.
Hello, everybody. This is Dr. Richard Smith, and you are watching Cycles TV, brought to you by the Foundation for the Study of Cycles. And very proud of what we continue to deliver to you here on Cycles TV and from the Foundation for the Study of Cycles in general. We are a not-for-profit, and your support and your membership is what makes this all possible. So thank you for that. And look forward to digging into what's going on in our world today with you over the next little bit. So today I'm going to do something completely different. I'm not even going to be talking about psychoanalysis, foundation style very much, but as the chairman and executive director of the Foundation for the Study of Cycles, I think a lot about why does the foundation exist? What do we need to be doing? And I can say confidently that one of the reasons that the foundation exists is to avoid the next depression. Okay. The foundation started after Dewey was the chief economist in the Hoover administration, tasked with trying to figure out what caused the stock market crash of 1929 and the Great Depression. And why did he do that? You know, was it just an intellectual exercise, just a curiosity? No. He wanted to make sure this didn't happen again. And friends, I don't know about you, but I am concerned. I'm worried. I think we are at the point where something like that could happen again. And I think it's our job at the foundation and our job as citizens to do our best to try to understand what's going on, try to bring a knowledge of cycles to bear on the situation, and try to avoid the worst case scenario. So that's what I'm going to do today. I'm going to get into that conversation. Obviously, you're not going to answer that question in a short period of time, but it was triggered by watching, well, I mean, it's triggered by everything that's going on, right? I mean, it's unsettling times, but it was triggered in particular by watching an interview of Ray Dalio by Tucker Carlson. I'll show that interview briefly, at least where you can find it. And Dalio was talking about his global debt cycles and the need to get the deficit today, federal deficit of the US government, down from 7.5% of GDP down to 3% of GDP. And I think that's a good goal. It's a good way to think about the problems that are going on in our world today. And I know we all want to time the markets and make sure that, you know, our butts are covered, but there's a bigger thing going on here. And that is what's going on in the world, what's going on in the US economy as the economic leader of the world. And how do we make sure, again, that we don't have to live through the worst case scenario? How do we take that all into consideration? So with that as preamble, I'm going to show you just today like how I worked with ChatGPT to dig into what Dalio was saying in that conversation, in that interview with Tucker, see what we can learn from that, see what framework we can elicit from that, and if it can help us as cycle analysts to help ourselves and help others through the foundation for the study of cycles. All right, so with that as preamble, and you guys, you know, tell me as we're going along here, if what you think, what your questions are. Okay, so this was the interview. It's on YouTube. This link was from the Economic Times. Ray Dalio forewarns Trump cut debt now or face economic heart attack. And he was being interviewed by Tucker Carlson. And it's a really good interview. It's 18 minutes long, and I recommend it. So what I did then was I took the transcript over here. You can go into the extra detail here and show transcript. Went up here. I removed the timestamps. You can turn those on and off, right? And then I just copied all this text. And I went into ChatGPT and I said, this is an auto-generated transcript of an interview by Tucker Carlson of Ray Dalio on the global debt crisis. Please turn it into paragraphs and sentences and identify the speakers, blah, blah, blah. So I gave it the whole transcript right out of YouTube, just like that, okay? And it actually took that and put it into not a verbatim transcript, okay, but a pretty good summary of the questions and the talking points from that interview. I was impressed. So we're going to go through that summary now and try to understand Dalio's main points about where we're at and what are some things that can be done today. So I'm going to move over to Microsoft Word here, where I just kind of broke this up to make it easier for us to kind of go through step by step. So Tucker says, Ray Dalio, thank you for doing this. You've run the biggest hedge fund in the world for a long time, and in order to do that, you've had to think about the rest of the world in a systematic way. In doing that, you've developed a framework for understanding what's happening now and what's going to happen. I'm wondering if you could set the stage with that. What are the 5 trends you look at to think about the future? Great question. Here's Dalio's summarized response. This is not a verbatim response. As a global macro investor for 50 years, I found that sometimes I was surprised by things that hadn't happened in my lifetime before. So I had to go back and study history, and that helped me a lot. There are 5 major forces that operate in big cycles, and those together define the environment we are living in now. Okay. There's the money and debt cycle. Number 1, we now have a major debt issue globally. This financial force is crucial because debt is money and money is debt. We'll get back to that. It's important. But very important that he is calling out these cycles that the foundation has been talking about for 80 years as well, before Dalio was talking about them. But he's doing a great job of bringing an awareness of cycles to the world, and we appreciate it very much. Internal order and disorder. This force drives internal cycles where gaps between political factions grow, leading to populism and social unrest. I believe we are in a form of civil war now within various countries, and certainly within the social media verse, let's say. So that's an important cycle. The great power conflict. When a dominant world power is challenged by a rising power, you get conflicts like the one between the US and China. Acts of nature, droughts, floods, and pandemics have historically killed more people and toppled more governments than wars. Climate-related issues now play a major role. Technological innovation, human inventiveness, particularly in technology, is a significant force shaping the world. Okay, those are 5 great cycle topics. Love it. Everything we're discussing today falls under one of these 5 forces, and they move in a largely cyclical way. Tucker, you just laid out the basis for the world's most interesting 6-hour conversation, but since we only have 17 minutes, let's talk about debt. Feels like we're at the tail end of a cycle or the beginning of a new one, the famous 80-year cycle, right? Dalio doesn't really ever say this is an 80-year cycle, but Tucker said 80-year cycle, and Dalio says, yes, this is a pivotal moment. Tucker, if we start with debt, can you give us a sense of the scale of global debt right now? Dalio, it's unprecedented in all of history. All of history. That's sobering. Let me explain how the big debt cycle works. Think of credit as a circulatory system. Credit brings buying power and supports financial assets, goods, and services. But as debt accumulates, it starts to squeeze out spending. So he actually, in the more detailed comments, he talks about the circulatory system of the body and the heart in particular, and the buildup of debt in the arteries of the economy as being like the building up of plaque in our arteries. And it's a great analogy, okay? And as debt accumulates, it starts to squeeze out spending, right? If your arteries that the wealth is flowing through the arteries of the economy, the spending is flowing through the arteries of the economy. If those arteries are clogged by debt, not as much spending gets through. So I thought that was a fantastic analogy, a great way to think about it. For example, in the US, about $1 trillion a year now goes to just pay interest on our debt. And over the next year, we have $9 trillion in debt that needs to be paid back or rolled over. As interest rates rise, that number gets bigger and bigger, right? So it's a catch-22 that we're in right now. How do we keep interest rates down, while at the same time, there's this risk going on that we don't, if the interest rates keep going up, the interest we're paying on our debt keeps going up, we can't service the debt. We all know how that story ends. There's a supply-demand issue with debt. One person's debt is another person's asset. Okay, we live in the fully credit-based economy today. It's all credit-based. Money is literally like a bank making a loan, issuing debt. That money, if I go borrow money from a bank, I get money, right? But the bank is holding debt. So my money is the bank's debt. And it's an asset to the bank. And if the bank doesn't think I can pay it back, right, it's going to try to sell that at a discount. So it gets to be a vicious circle. When that happens, interest rates rise. As interest rates rise, asset prices can decline, and this triggers financial instability. The central bank then faces a choice: let interest rates rise, which hurts the economy, or print money to buy the debt. But printing money leads to monetary inflation. Right now, we are in that situation. When I calculate supply and demand for debt over the next 1 to 3 years, we have an immediate issue. Immediate. I agree. Can you be more specific? What does that issue look like if it's not addressed in the next 3 years? Galileo. If not addressed, debt holders and buyers won't buy enough to meet supply. That means interest rates rise. Rising interest rates hurt the economy and asset prices, many of which are already expensive, decline. At that point, the central bank is forced to decide, do they print money or buy the debt? If they do, the currency depreciates. You get monetary inflation if they print money. That affects everything because the US Treasury market is the backbone of the global financial system. A problem there triggers a problem in all markets. When money no longer holds its value as a store of wealth, people start selling off assets. That creates a self-reinforcing cycle of selling, rising interest rates, and economic contraction. And that is what we have to avoid. Okay, it's not inevitable. It's hard, but we do have to avoid this. We do not want a self-reinforcing cycle of selling, rising interest rates, and economic contraction. So the US government is running a deficit of about 7.5% of GDP. If Trump's tax cuts continue, you expect that number to remain high. You're saying the deficit needs to be cut to 3% of GDP to avoid crisis. Right? The idea of tax cuts, that is actually lowering the ability of the US government to pay to service the debt. Okay, so that's not going to lower GDP by the deficit to 3% of GDP by itself, right? It might stimulate growth. That's the hope. But tax cuts by themselves, don't solve the problem. They exacerbate the problem. Galileo, exactly. Every policymaker and the president should pledge to get the deficit to 3% of GDP. Otherwise, we are likely to have a serious problem. Excuse me. Tucker, but that's a tight timeline. I think most Americans assume this is a problem for the distant future. You're saying it's imminent. Sorry. Ray Dalio. Based on my calculations, we have about 3 years to adjust. You need to make spending cuts now while the economy is still relatively strong. Otherwise, the debt keeps growing and the adjustment becomes far more painful. It's like going to a doctor. If I tell you, Tucker, you have plaque buildup in your arteries, you don't wait for the heart attack to happen before you start making changes. You need to address it now while you're still healthy. Well, questionable how healthy the patient of the US economy is today, but it's not going to get any healthier, as the days go by. Tucker, but when governments make drastic spending cuts, because spending cuts is one way to lower the deficit, right? They risk political instability. Yeah. People expect the government to provide certain services. When those services disappear, you get unrest, sometimes even violence. Are you more concerned about the debt crisis or the potential political blowback from fixing it? Galileo, both are serious risks, but at this stage, the bigger risk is not acting fast enough. You must take action and make adjustments while things are still manageable. there are three main levers. Taxes, not necessarily raising tax rates, but increasing revenue through economic growth. So raising taxes is one way to lower the deficit. But can we also increase tax income, right, through economic growth? That's the theory of cutting taxes, stimulating growth, tax rates, right? Stimulating growth, ultimately generating more economic activity and more tax revenue. The tariffs idea is another way of getting income to offset the deficit. Spending cuts, reducing wasteful spending, but ensuring it's done in a tolerable way. And interest rates, managing supply and demand so interest rates don't spiral out of control, right? I think $1 trillion of our $1.8 trillion deficit is interest on the debt. So if the 10-year yield keeps going up, that payment on the debt keeps going up and makes the deficit bigger. So Treasury Secretary Bessent has come out and said, you know, our target is the 10% yield, or the yield on the 10% Treasury. We want to see that come down. We know that's hard, right? James Carville famously said he wanted to be reincarnated as the bond market because it can intimidate anyone. So they're right. Bessent is right. Trump is right that we do need those rates to come down, but it's hard. And as cycle analysts, you know, I have basically one chart to show us today, which is this long-term famously said he wanted to be reincarnated as the bond market because it can intimidate anyone. So they're right. Bessent is right. Trump is right that we do need those rates to come down, but it's hard. And as cycle analysts, you know, I have basically one chart to show us today, which is this long-term 85-year cycle in 10-year yields dating back to 1787, right? And Dalio is talking about an 80 plus 75 to 100 year debt cycle. Okay, here it is. So, you know, these dates are a little bit off. That was like January of 23, when we were at 3.22%. Bottom line, this cycle, you know, is headed up. So we've got a very powerful cycle that is tending towards higher rates. Okay, it doesn't have to be 16% on the 10-year yield like it was in 1980. Okay, at the peak of the cycle back before the Civil War, it was about a little above 6%. Okay, so it doesn't have to be this, but we've clearly got headwinds against lower rates, tailwinds for higher rates on the 10-year yield. So this is not going to be an easy fight to bring interest rates, keep them under control, keep supply and demand in the biggest financial market in the world, okay, under control. None of us should want to see the 10-year yields above 5 or 6%. That's going to be big trouble. So Dalio then goes on to say that between 1992 and 1998, the U.S. successfully tightened fiscal policy by about 4 to 5% of GDP without causing a major crisis. It's possible to do this again if we move quickly. Interesting. Tucker. Some argue that today's debt crisis is a direct result of artificially low rates after the 2008 financial crisis. Do you agree? I certainly agree that rates were held artificially low after the 2008 financial crisis. And I think that's a big part of the problem that we're facing today. If we go back to that long-term chart, I said this back in the beginning of 23, but this was unprecedented to have rates down, below or to basically 0% on the 10-year yield. And it's like pushing a beach ball under the water. That beach ball is going to pop back up, and it creates a real danger of that 10-year yield moving to the 5-6% range or higher. I think that's a real risk, and I think it's a serious, sobering risk that none of us should want, even if we're betting on, higher yields and lower bond prices. All right. But it's going to be bad news for all of us if that happens, and nobody should wish it on anyone. Dalio, since 1944, debt was used in a healthy way. Borrowing created enough income to service the debt, right? You can have debt, constructive debt's okay, but you better be able to service it. And we're kind of in a questionable range of our debt serviceability right now. Over time, more debt was taken on without sufficient income growth to support it. The situation reached its peak during two major fiscal stimulus events: COVID stimulus packages, massive government borrowing and direct payments to individuals, and post-COVID spending and wealth transfers, more government borrowing to fund various programs. This led to inflation. It was entirely predictable. You can't send out trillions of dollars and expect no consequences. Thank you, Dalio. Well said. Tucker, yep. Many policymakers seemed shocked by inflation. Dalio, they shouldn't have been. It's basic economics. Exactly. This isn't just a US problem, it's a global debt problem. Europe, China, and other major economies are dealing with the same issues. And remember, debt crises don't just cause financial problems, they fuel political instability. If governments can't manage debt properly, they create internal conflict. That leads to geopolitical instability at a time when international tensions are already high. Okay. So that's really the summary of what Dalio was talking about in this interview. They fuel political instability. That goes back to the other types of cycles, right? The internal conflict cycle, the external conflict cycle, natural disaster cycles, and technology cycles. So all those are part of it. Now, not everything got captured in this initial summary by ChatGPT, but it did a pretty good job. So now I'm just going to share with you some of what I've been doing to try to better understand this problem using my own experience and ChatGPT, right? And I do think it's a good illustration of how these tools can actually, how we can use these tools, right? The tools don't answer our problems. They don't give us the answers. They help us to reason through problems and to explore solutions ourselves, okay? The computer won't give you the answer because there isn't an answer in that computational deterministic way. It's just life lived experience. How am I doing on time? All right, so I then, I wanted to get a little more detail from ChatGPT. I asked it, what was the original word count of the transcript and what is the word count in your final version? Its answer was completely wrong. Talk about hallucinations. The original transcript had approximately 233 words. No, it didn't. It had over 2,000 words. I looked at it in Microsoft Word. While the final revised version has 309 words. No, it didn't. So ChatGPT does not know how to count. Okay, forget about counting. So I went through a bunch of iterations until I finally just started giving it chunks of the transcript. I had to go through the transcript myself, break it up into chunks, and get it to clean it up. And it did. It finally did a pretty good job of that. So, I'd take a chunk here about here's what Ray said, and then I'd ask chat to clean it up, and it did a good job. So through that, I was able to get a more detailed version of the transcript, but it took a lot of work. Okay. And I think it's a good example just of what this technology can and can't do. On the one hand, it did create a summary for me just out of the gate that was pretty good, but it missed some big things. And then to get it to do what I really wanted it to do, it took a lot of work. I'm not sure I would have really saved that much time or gotten a much better result than if I had just kind of gone through the rough transcript myself and edited it into a final document, which is basically what we did with ChatGPT here. So I'm not going to take you through all that. I'm going to get down to some of the follow-up questions I asked ChatGPT to take us through. Okay. So thanks for all that. Now I have some questions about Dalio's thesis. Can you explain how debt is money and money is debt? So yes, when Dalio says debt is money and money is debt, he's referring to how modern financial systems work under a credit-based monetary system. A credit-based monetary system. That is what we live in today. Okay, money in today's economy is mostly credit, i.e. debt. In our financial system, most of what we call money isn't physical cash, it's credit created by banks. When a bank lends money, it creates a deposit in the borrower's account. That deposit is considered money, but it's actually debt that the borrower must repay. If you take out a $10,000 loan, the bank credits your account with $10,000. That $10,000 didn't exist before. It was created through debt issuance. You now have money, but the bank holds an IOU or debt from you. Okay, so that is how our economy works today. So in this way, money is debt because most money in circulation was created through borrowing. There's a lot more detail in here. Bottom line, money is debt because most money in the system is created through loans. Debt is money because government bonds and credit instruments function as forms of money in financial markets. The risk when debt levels get too high, it becomes harder to maintain economic stability without triggering inflation, devaluation, or defaults. That's where we are today, right? This is the core of Dalio's concern. If debt becomes too unsustainable, the entire financial system faces instability, and that leads to political instability. So I said, how far back in history does our modern financial system go? When did money as debt get started? The idea of money as debt goes back much further than most people realize. While our modern financial system has evolved significantly, the core principles of credit-based money have existed for thousands of years. Going back to 3000 to 500 BCE, right? There was even credit back then. Merchants and farmers borrowed grain or silver with a promise to repay after the harvest. These early forms of money were not physical, they were records of debt. Okay, so it goes through some interesting history, which is cool. And then the fully credit-based system, 1971 to present, after the US went off the gold standard, right? After 1971, all money became debt as central banks and commercial banks could expand the money supply through lending without physical backing. No physical backing, right? Today, over 90% of money exists only in digital form. And the Federal Reserve and other central banks now manage interest rates and liquidity by controlling credit flows, not gold or physical money. This is why the liquidity flows that Michael Howell was talking about in his interview with Lars von Tienen are so important in markets right now. So when did money as debt start? The concept dates back at least 5,000 years to Mesopotamian debt ledgers. Okay, sort of. The modern system where most money exists only as bank credit and government debt fully emerged after 1971 when the gold standard ended, right? That was just over 50 years ago now. And there's no anchor anymore, right? It's fully credit-based, and that's a kind of terrible power that is wielded in our world today. Dalio's concerns about excessive debt and instability are rooted in this transition. Once money is purely debt, governments and central banks have no limit on how much they can create, no limit, which can lead to devaluation, inflation, or financial crises. Tucker mentioned an 80-year cycle, which Dalio seemed to agree on. Does Dalio have a theory of an 80-year debt cycle? If so, please summarize what you know about it. Okay, so yes, Dalio does incorporate the idea of long-term economic cycles. He talks about a 75 to 100-year cycle and the short-term debt cycle of 8 to 10 years. We just saw Martin Armstrong talking about an 8.6-year cycle. You know, it's basically the business cycle. So we have this kind of long generational, 3 or 4 generations, Neil Howe, the fourth turning, and the shorter term, you know, 8, 9-year, 10-year business cycle. I don't think that's new to any of us. I mean, this is pretty cool stuff though, right? Like some historical 80-year debt cycle examples. The American Revolution and French Revolution, US Civil War, Great Depression. Cool. Awesome. Are we at the end of the current 80-year cycle? Dalio suggests we are in the final stage of the current long-term debt cycle. All right, so there's a lot here. I want to get to some conclusions, some ideas for moving forward from here. So I'm going to skip over some of this, but I still think you can do this yourself, right? You can have these conversations with ChatGPT or others. And again, you know, other tools. They're conversations for you to enhance your own understanding. And you don't just take its word for it. It's a process to work through to help us together better understand what's going on. These are some pictures that it found about Dalio's cycles. Actually, let me go. Yeah, here's the one that kind of showed the longer term and the shorter term cycle together, which I thought was pretty cool. All right. This was looking at the way the different cycles fit together, acts of nature, technology. But I want to get to some conclusions. I asked, what is the current federal deficit and what's the current GDP? Right, current federal deficit, $1.8 trillion. That's not the total debt. The total debt's in the $30+ trillion, right? But that's the deficit. And GDP was that was a monthly deficit. Oh, 29.7 trillion, about 30 trillion. $1.8 divided by 29.7 is about 6.1%, but Dalio said we're currently at 7.5%. Is he wrong, or did you or I make a mistake? He's in the ballpark, right? That's fine. All right. Moving on. I started asking Trump's tariffs could be a source of government revenue, right? Yes, tariffs could be a source of revenue. Selling federal assets, land, buildings, infrastructure, that could be a source of revenue. Repricing U.S. gold reserves, we've heard of that. That could be a source of revenue. And Dalio, let's see here. How do these compare to Dalio's 3 levers? 3 levers being like tax income, spending reduction, and keeping interest rates low, right? Tariffs, asset sales, and gold repricing could all play a role in deficit reduction. Yep. I said productivity gains could also spur growth and increase income. Is there any recent evidence of productivity gains in the U.S. economy? Yes, recent data indicates that the U.S. has experienced notable productivity gains. Got some information there. How about improved health in the U.S. population? Could that improve productivity? Yes, improved health could significantly boost productivity in several ways. Talked about that for a little bit. So now I started to get into what longer-term series data could we track and analyze in order to follow some of these trends and look for indications of success or failure in achieving Dalio's goal of a 3% deficit to GDP ratio. And now it started getting pretty interesting. Fiscal and debt indicators, right? Federal budget deficit, total national debt, gave me sources of where I could find those things. Economic growth and productivity sources, inflation and interest rate environment sources, labor market and workforce health sources. Super cool. Global trade and tariffs. How to use this data to assess success or failure. And then it said, you want me to build you a dashboard? I said, yeah, I'd love that. Build me a dashboard. Can you build me a dashboard that tracks all of that? No, its first effort was pretty weak. Just gave me a list of the indicators so I could fill in the values myself. I said I wasn't too impressed. Can you get me the historical values of those data sources? I'd love a URL to the data source and a spreadsheet with as much historical data on each of these indicators as possible. So I haven't gone through all this yet, but it did start to give me some links, which is pretty cool, to look for these data sources, which I'm going to do. Try it again. Now, can you get that historical data for me and put it into a table with dates aligned? No can do, it said. But still, it's pretty good list here with some sources to follow up on. So again, I tried to get it to give me a little more help. Gave me some suggestions about how to do it, but wouldn't do it for me. But I do think this is some stuff that we could follow up on. So lastly, I said Dalio says that the U.S. successfully lowered the deficit by 4 to 5% of GDP between 92 and 98. Is that true? If so, what were the key drivers that helped that happen? And what are the key differences between 1992 and 1998 today? So this was really interesting. Dalio's assertion that the U.S. successfully reduced the federal budget deficit by approximately 4 to 5% of GDP between 92 and 98 is accurate. In 92, the deficit stood at 4.7% of GDP, and it decreased to 0.3% by 1997. Okay, so over 5 years, it went down about 4%, which we'd have to get down 4.5% today to do that, right? Key drivers of deficit reduction, economic growth, fiscal policies. Key differences between 92 and 98 and today, I asked about that. And I said, okay, so using Dalio's own metaphor, is the difference between 92 and 98 today that there is more debt-based plaque built up in the arteries of the U.S. economy? Yes, using Dalio's own metaphor, the key difference between 92 and today is that there is far more debt-based plaque built up in the arteries of the U.S. economy. In the 1990s, the economy was able to clear out some of the excess, but today the buildup is much more severe, making it harder to restore fiscal health without major disruptions. I think that is spot on. Comparing 1992 versus today using Dalio's plaque in the arteries metaphor, 92 to 98, you had 60% of GDP was the debt to GDP ratio, and now it's over 100%. The annual deficit was declining towards 0% of GDP. Now it's stuck around 6 to 7.5% of GDP, right? So this is a great list here. And lastly, wrapping up here, I said, I like the late stage heart disease analogy. If we're going to think about things through that lens, and I think that we should, then maybe we need to think about a slower recovery time than what Dalio is proposing. Dalio is proposing to do in 3 years what was done in 6 years between 92 and 98. Meanwhile, our patient is in much worse condition today than it was back in 1992. Chat says, that's a brilliant insight. Thank you. If we stick with Dalio's late stage heart disease analogy, then expecting a full recovery in just 3 years when it took 6 years under far better conditions might be unrealistic and too aggressive. Why a slower recovery timeline might be necessary. Okay, so that's pretty much it. A more realistic cardiac rehab approach. Instead of crash diet plus emergency surgery, we might need a bit more gradual 6 to 10 year recovery plan. Stabilize the economy while slowing debt growth. Maybe target 5% instead of 7.5%. Implement gradual spending reforms, bring deficit towards 4%. If economy remains strong, finish the job and bring deficit to 3% or below sustainably. Avoid shocking the economy into recession. Gives policymakers room to adjust growth. If growth slows or interest rates spike, maintains investor confidence without overreacting too quickly. Dalio is correct that action is needed now, but if the U.S. economy is in late-stage heart disease, then an overly aggressive plan could cause more harm than good. A gradual 6 to 10 year stabilization plan might be more sustainable and politically feasible. Goes on, offers me some historical case studies. That was interesting. And key takeaways for the United States today. Economic growth. Sustainable and inclusive economic growth is crucial for increasing GDP and reducing the debt to GDP ratio. Huge. Comprehensive tax reforms and prudent spending are essential. This may involve difficult political decisions to balance the public services with fiscal responsibility. Political consensus, achieving bipartisan support. That's kind of discouraging, wouldn't you say? Is vital for implementing effective fiscal policies. Historical examples, such as Canada's political consensus in the 1990s, highlight the importance of unified action. Structural reforms. Addressing long-term liabilities, such as entitlement programs, can help manage future debt. All right. That's it. That's what I got for you today. Summing up, I think Dalio's analogy of late-stage heart disease in the U.S. economy, plaque building up in the arteries, restricting spending. We have to be realistic about where we are in the cycle. This is what a knowledge of cycles can do for us, okay? They can help us navigate our situations more realistically. And if we pretend that the cycles don't exist, if we pretend that we're not, in a big debt cycle right now, that there aren't tailwinds for higher rates that are going to require more than Trump waving a magic wand and magically getting the bond market to cooperate, that's not going to happen. We're in a serious situation, and that is what the cycles tell us. And we have to figure out how to manage that situation in the context of ongoing cycles. How can the business cycle work in a way that we can ultimately bring down our debt to GDP, bring down our annual deficit? How can the annual seasonal cycle potentially be understood to help us navigate this bad situation? And it is a bad situation. There are no winners here, okay? There are not winners and losers. We're all going to be losers if we don't figure this out together. So that's what the cycle tells us. They're bigger than us, bigger than red and blue, bigger than the US and China. And I mean, in many ways, that's the hope, right? That we can all see that we've got this big problem and that we better work together to figure out a way out of it. And we better not just stick our heads in the sand about the reality of the cycles that we're in the midst of. So I think that's it for today. Again, this is the beginning of a conversation, not the end. I haven't provided a bunch of answers. I do think that through that exercise, I was able to better understand what we're really facing right now, where we are, and also that idea of looking back at the 92 to 98 example and going, well, we were in much better shape back then, and it took 5 to 6 years to lower the deficit by 4.5%. Maybe it's going to take 10 years now, but that's starting to get realistic. But I do think that is a common goal that we can all, row in that boat together towards and get a lot of bipartisan consensus on. And I think we really need to do that. So please do let me know your thoughts. Where am I at? 12:48. All right, let me just see here. Looking at your questions. Improve health to work longer. Yeah. And just improving health in general. I mean, my family's pretty healthy, but even in my own family, we've had issues that have been kind of chronic and debilitating and limited the full ability of what we can do. Long COVID stuff. And I think a lot of people are going through that right now. How do we get past that? If we could get past that, could that help the economy? Absolutely. The audience might like to read Sidney Homer's History of Interest Rates. I have that book somewhere. It's like a doorstop. And appreciate the recommendation, Dale. Somebody wants to tackle it, by all means. Less inflationary and better for the economy if the government did not print to borrow, but just printed without borrowing. Debt to equity coupon on current debt, then abolish government borrowing. Interesting. I'll have to think about that one a little bit more. Thank you. Mark, Dr. Smith, when asking ChatGPT questions, if it does not produce the answers you're looking for, try asking again in a couple of days. Yeah, it is, look, these tools are very powerful. I use them. I'm a big fan, but you do have to take responsibility for your own knowledge. You just got to do that. You cannot accept that these things are going to give you answers. And it's a terrible idea to think that, oh, well, it's all going to get better and better over time and they are going to give us the answers. No, that's not how it works. If we go down that path, we're not going to get the benefits out of this technology. I promise you. DR, have you heard from Jake? Yeah, so, okay. Fed does not control long end part of bond market, only the short end. Crisis in government and the debt they do not want to pay. Current. All right. Cicely Ann, thank you. I don't quite get it yet, but I'm going to look into it. Start to reduce blood pressure to avoid plaque forming clots. Blood pressure of the USA looks bad. I agree, Leanne. Trump is familiar with the process of debt to equity swap. I'm not completely unhappy that we've got a bankruptcy expert at the helm, along with Scott Bessent, who was George Soros's, currency trading right-hand man, like knows how to manage a currency crisis, knows what goes into a currency crisis. I wish we weren't at this point, but not bad skills to have for where we're at. Bruno, thank you. Let's see. Elliot, it would be outstanding. You have your ChatGPT interview available as a readable document. I'll see what I can do there. Bruno, are the American developed world consumers ready to reduce their standard of living to repay partially the debt? I think that's a great question. And, you know, reminds me of the Kennedy, famous Kennedy line, right? Ask not what your country can do for you, but what you can do for your country. And I do think that people are willing to seriously consider things like that at this point, Bruno. Reasonable people are. And, you know, I'm afraid that the reasonable people get drowned out by the algorithm-driven media nonsense of our world today. But there are a lot of reasonable people out there, more so than the psychopaths. And I do think most of us are willing to make personal sacrifices in order to have a better future for future generations. Why should consumer reduce spending? That's bad for economy. Better to grow the economy. I agree. You know, but there's a lot of things that go into growing the economy. The biggest one is cooperation, togetherness, unity. That's the thing that I really fear the most right now. You know, the algorithm algorithm generated conversations that we're having right now because our media just doesn't even exist. But like I said, cycles can help us to understand the waters that we're swimming in, right? Who wouldn't want to understand the tides? If you got to get your boat out to sea, you want to understand the tides. And we're in the midst of tides in the affairs of men. Edgar Lawrence Smith. All right. Thank you, everybody. Thanks for listening. Thanks for the opportunity to think through these things and to do this together under the banner of the Foundation for the Study of Cycles. We'll keep on it, and please keep in touch. Let me know your thoughts. Post your chat, your comments. Bring other people to this channel. Ray Dalio, if you're out there listening, thank you. And we'd love to work with you and bring a knowledge of cycles to more people together. So see you next Tuesday, if not before. Thanks, everyone. Bye.
All right, perfect. 2 hours. You can go check out the channel at YouTube/@FSCTV. And you can go to the Cycles website, cycles.org. Okay. So those are 2 places you can go. Get more resources there. You can see everything there. And if you're willing to pay, yeah, you can pay. Donate some money or, you know, get some access to their special tools that are keeping or being kept improving, you know, right now. So I'll have to see how that goes. Hopefully I can get some more information. And they keep doing it nicely because I'll need them. In the coming years. It's going to get worse and worse right now. For the near term, just watch March to April. We are going to have the last week here, and we're going to get into NVIDIA's earnings on Wednesday. That's the big thing. And I'll see you guys then. I don't know what I'm going to do tomorrow. I don't know if there's going to be a big trade, except for natural gas. I'll see if Bitcoin might want to do something or not before. But yeah, Bitcoin's going to have Ethereum. Also is going to have the options expiration, futures expiry, all on Friday morning. So early Friday morning in UK time. It usually ends around there, sometime around that, or a few hours before or after, I forget. And then after that, What else? Oh yeah, Litecoin was also mentioned on that Joe Rabel video. So Litecoin to me is kind of like the silver to Bitcoin's gold. They kind of have a relationship. Litecoin has been performing quite well these past several months comparatively, and all the other altcoins have pretty much been giving away some of their gains over time. So, but if Litecoin is still doing all right and it can recover from Friday's walloping, whatever you want to call that, yeah, maybe it'll be good because I need to see that improve. All right. Okay, guys. See ya. Good night.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Like I should